Hey traders, Raghee here, and in this recap video for Simpler Futures, I'm going to be talking about positions that we took into the weekend, a little bit of insight into how those positions are doing, and more importantly, how we're managing them going forward. So on Friday, the idea was during the chat room, we sent out a couple text alerts, and during the chat room we managed all 5 of these trades live, which was a Nikkei set up long, NASDAQ set up long, S&P set up long, Dow set up long, and a Euro US set up long. And the idea behind them was that these levels were reaching kind of a post-panic frenzy level, but that I did not want to guess at where the support was going to kick in with an exhaustion level buy, but rather we would utilize the bullish momentum on an intraday time frame to get long, and this is what I call a wave reversal. This is one of my favorite intraday setups, especially when the market is trading at a level that I think it could reverse from, but I don't want to buy that ceiling or buy that floor. I'd rather wait for the market to get rejected off that ceiling or rejected off that floor. And it's the rejection off the floor is what we took advantage of here across 4 different indexes. NAS was one of them with a 58.05 buy, the Nikkei as well, and the Dow. I'm going to specifically get into the Nikkei and the Dow here for this video. Now, taking a trade like this into the weekend would have been fairly dangerous for a number of reasons, most of which the uncertainty of the weekend would be, I think, the major concern that we would gap down. But because the market actually came off lows going into Friday's close, and because we could make a pretty good argument, it came off lows going into Friday's close, but also Thursday's close, and it wasn't like we punched down to lower lows and accelerated again. The market was actually going into a pause, thinking that it had discounted the worst case scenario. So, of course, the risk is that the worst case scenario was, in fact, not the worst case scenario. But since the market had pretty much discounted war, I mean, I'm not exaggerating, no hyperbole, there was a lot of negativity. This just turned into more of the market doing what it's been doing best, and you guys might know what this means. Yeah, BTF, and that's supposed to be D. And to me, this was the opportunity. The risk was that we end up long. The alternative was to buy calls as the market was selling off, so you have a much more risk-controlled asset class, meaning calls in NQ, calls in YM, calls in NK, calls in ES, as opposed to the actual physical position. Now, the way we entered again was the wave reversal. The way we're going to manage it continues to be that same wave angle on the same time frame that we triggered these trades on. So let me take you to the NQ to show you how we're doing this. The idea is to have, and if you want to grab pen and paper here, because I'm going to show you some basics here. The idea is to continue to follow the valid trade strategy here, which would be buying pullbacks within the context of this uptrend. So we can continue to do that, but I'm already long. So what am I using this uptrend for? The validity of the intraday uptrend. So the validity of the intraday uptrend should ideally be able to absorb the upper end of the daily price movement range for this particular market. So let me show you what that is. So what I do is I get very objective about it. I'm not guessing. I'm not using a dollar number or a point or percentage. I'm using the typical price movement range of the contract to say, look, I need to give this market at least 20 to 26 pips of cushion to let it do its thing and not smother it. So if it is going to be able to follow through, I want to know that I can handle 20 to 26 pips actually to the downside and still remain above the 34 EMA on the low, which is the validity, or what I call the POV of the trade. So if I could subtract again 20 to 26, and I can still stay above the 34 EMA on the low, that time frame can handle the shock absorption, or the typical hourly price movement range volatility on the upper end, and still allow me to follow the trend, or at least use the validity of this time frame's trend, which was the time frame I used to get in, and remain in the trade and just see how high is high. Right? How high are we going to go? I'll just manage this from Not this time frame, actually. Here's where my targets are. Let me show you this here real quick. My upside targets are 59.20 to 25. After that, after taking about a third of the position off the table, or even a quarter, but I'll go with a third. Even up to a half, by the way. You can even take half, and that leaves you another half to look at. 59.70, 59.90 is the next target to the upside. And if you take half and pick one of these to take a quarter off the table, you can leave a quarter of that overall position on in case we break 6,000 and we break the high at 59.95. Wow. And would you like to have a position open in case we break 6,000? Absolutely. But what you can do is only risk unrealized profits, which is exactly what we're doing and the mode that we're in right now. I'll see you in the next update.